Good day, fellow investors. We're going to go through the top 10 oil producers to get a bottom-up perspective on the investing opportunities in the oil environment. Just before we start, for those who don't know me, my name is Sven Karlin. I do research, I look for value investment opportunities, and on my research platform you can find a detailed investment opportunity / strategy value pillar if you want to add that to your portfolio. It means low risk, high reward, as it was for oil stocks in September of 2020. But let's immediately start with oil stocks, and the key, as it always is the price. Over the last 3 years, we have seen a clear declining trend with oil stocks. So from the high of 120 to the current low below 60. Now the environment is one of oversupply, hated environment. There is too much oil. Who will win, who will lose is the most recent news. But if you go back to 2022, June 10, then these were the highlights there. June, oil spending won't recover in 2020 as war riles market. So that was the reason for the high prices back then. However, things have changed, and now we are looking at much cheaper oil prices, which could also be a better buy. It's much better to buy oil-related investments at 60 than at 120. So let's go one by one, and it's very important to even discuss the Saudi Aramcos, the Petrochinas, because those give a great overview of what's going on, and then we'll of course dig deeper into Exxon Chevron. Saudi Aramco, as they call it. So the stock didn't do well since its IPO. It has the dividend, but that's about it. If we look at the results, of course, they have very low production costs, therefore they are always profitable, but they are increasing their gas targets, more production. So with lower prices, they are even able to increase net income because of increased production and increased cash flows. They are focused on more gas production, LNG exports, and that is where they see their growth story. They expect record demand in oil and then growth going forward. In this case, we see here the S&P projection. And now they say also that this is the story with oil, that the resources are lower than the depletion, and therefore that there is not enough investment in oil future. But when you look at the resources, always keep in mind those are 8-12 years ahead. So companies can, let's say, play around and go to the lower bound to save the cash flows. If you invest the cash now for this 8 to 12 years, it doesn't change, but you can invest it in year 6 for year 9. That is very important always to keep in mind. Nevertheless, gas growth program, downstream growth, higher cash flows, higher dividends, but we have seen the stock to go down. Also, liquid projects increased. So, as you will see with all other companies, everybody is projecting growth. But the stock doesn't move, and the stock follows oil prices. The dividend 5.4%. Rosneft is the second one, but going into Russia, didn't find the presentation there, so we don't know what will the situation be there 6-12 months from now. So let's skip that one and go to Petrochina. Petrochina, the stock crashed from the 2007 commodity exuberance peak, and since then it has been lingering there, so it's just a dividend of 4.7%. Let's look a little bit at numbers. It's doing good. You can see here output increasing a little bit. So China has its own production. It's just a small part compared to imports, but they do produce oil. And you can see here all the basins and whatever they have there. And they are increasing their investment producing, so they will also likely add the 2-3% growth from there. So Petrochina, Saudi Aramco, 4-5% dividend yield. Let's now go to Exxon. Unlike the other two, Exxon, the stock has just been going higher after the 2020 crisis. The dividend yield is 3.5%. And if we look a little bit at the company, they are expecting a lot of growth, especially from their last capital markets day. So wherever you look, there is Exxon. Their total addressable market will be 2.3 trillion over the long term. So this is even more exuberant than Palantir or OpenAI. So crazy projections with Exxon, but this is different than any other oil major that we will also see. Perhaps they asked, okay, what would be the most exuberant projection you can have? And they asked each employee, and these are the results. Nevertheless, maybe they can do it, maybe not. The time will tell. But their projected demand growth, energy demand growth is there. They are a little bit more flattish, a little bit more realistic on the oil. They still see it there in 2050. And then when it comes to money, they see potential cash flows, 20 billion earnings potential, and 30 billion cash flow potential. And where do they see that? From the volume earning mix increase, there's even more production as all other companies, Permian, Guyana, LNG. And you can see here, they see more cash flow production on top of everything, 165 billion extra at 65 real Brent. So 2030, they say that would be 75 oil, depending on inflation. And if you look at the situation, they even tell you how much money they will make. I've seen this with Brookfield. These guys are even crazier. So 18% total annual return potential, earnings growth of 10%, buybacks, and the current dividend yield. As said, that implies 65 real Brent, that's 75 nominal prices on their expectations, and then that also all the projects go well. As you can see here, upstream, increase, growth, product solutions, everything is growing there. However, again, it will all depend on oil prices. And at current levels, if I look at the cash from operations, capex, for the first 3 quarters of the year, we are at 18. If I round it up to the year, we'll likely see $25 billion of free cash flows from Exxon. How they have spent it? 10 billion for buybacks, 17.7 billion dividend, and that is the 5% cash flow yield that Exxon is offering at the 500 billion market capitalization. But of course, if they can add the 20 earnings, 30 billion on top of it, then that would be 57 billion, let's say, of earnings or cash flows for an 11% cash flow yield. So the dividend would likely double to 6% plus 5% of buybacks, if the stock stays where it is. If the stock goes higher, the yield on the current cost will be higher, of course, but the buybacks will have less effect. And then again, typically Exxon, they are in the league of their own. The rest of the competition doesn't exist, doesn't matter. Now, they are either totally the Lulu or it is the reality. Time will tell. But when it comes to the situation, it's all about prices. If oil is at $50, for example, you can immediately take out 10 billion, and then from the 17 billion earnings, you're down to 7, and 7 on $500 billion market capitalization doesn't look good. So the 10 billion at oil at 50 or lower wouldn't even be enough for the dividend. And that happens here and there with Exxon. We have seen it 2020, 2015, 2010, 2002. So keep in mind, as always, oil is cyclical. But okay, lowest dividend till now, let's go to Chevron. Dividend 4.5%, $300 billion market capitalization. They are going for nominal $70 Brent price on their assumptions, 10% free cash flow growth, annual production 2 to 3%, and higher dividend growth, amongst others. They expect oil and gas to stay high, demand, and you can see here again existing supply, capital assisted decline to decline, and therefore you will need higher oil prices to justify investments. That's at least their strategy. And for now, as you have seen, everybody is investing in growth. So how can the existing supply decline? That's a key question we'll try to answer through this video. And then again, in this case, Chevron is better than all the other peers, even if we're looking at peers, and the peers also don't look that bad. Break even, let's say 50, so the dividend plus capex break even. But it's now a little bit higher on 2025, so they expect stronger cash flows from growth, from efficiency, and things like that. They are buying back shares and trying to focus on that, and then depending on where oil will be, dividend, some buyback capacity, buyback and dividend if it's higher. If oil is at 60, we have, let's say, 50 billion of dividends plus some 30, let's say 80 billion divided by 5. That's approximately 16 billion. Compared to the 300 market cap, that's around 5% dividend and yield, free cash flow yield on the 60. So not that attractive. And because they have higher costs, the sensitivity is of course higher. The lower costs you have, if oil prices go up, the lower is your sensitivity. So Chevron is even riskier on that situation. And you can see here, again, growing as everybody else. 2 to 3% production growth over 5 years is 10 to 15% growth, even more, and that will add to the global supply. And we have decades of resources, basins, growing production, powering AI, even with oil, things like that, AI to advance the future of energy. So that is something that everybody else will use. They also try to go to lithium, things like that. So major capital projects, a lot of things to do. But if I make the calculation, around 5% free cash flow yield at oil at 60 just to cover the dividend. And that's about it. So there is Chevron dividend, some buybacks at current oil levels, not that much. Therefore, when you're looking at these yields, this is pretty expensive, especially the Chevrons and the Exxons. Now, if we go to Brazil, Petrobras, let's look a little bit at the numbers. Everything looks good at current levels, great cash flows, 5 billion free cash flow in the quarter, production 17% up. So even they are increasing already production, they are investing a lot. They do have a lot of debt compared to the Exxons and the Chevrons, but they are committed to remuneration, dividends. But if there is again a significant change in oil prices, they are also very, very sensitive, and they require 45 oil to be profitable. So my take is Petrobras should survive. However, it has higher debt. If oil prices are lower for longer, then you will see government intervention, things like that. Very ugly, risky situations. So there is the upside on the oil boom, but as all other players, Petrobras is also going for growth. Here is another projections for oil demand, and most say stable or growing, but you can see here declining. Then depending on the scenario, going even lower and lower. So we'll see. Now oil majors are saying flat to 2050, so around 100 at least. But given the technological developments over the last 10 years and likely the increase in speed in those, let's say that this is the most likely scenario. So oil supply might likely be there to justify the decline in demand. Petrobras, 10% yield. Let's go to Shell. And you can see here, as I always tell you, oil is a cyclical beast, and that is also how you have to accept it. We'll discuss that also later, but there is the time to sell, there is the time to buy, and especially the exuberantly priced oil majors. Because over the long term, adjusting for currency fluctuations, companies don't do much more than the dividend. All have done capital markets day as the situation seemed well. Now they likely stay a little bit quieter, but then again, growing, constantly growing, and outperforming peers since 2023. So look how smart we are. You haven't performed since 2001, but okay, that is oil management majors. And you can see here, they are growing on gas and LNG. That's their focus. Same competing with Saudi Aramco. Good luck with that. But okay, nothing wrong there. Buybacks, dividends, depending again on oil prices. At 50 oil, they will still have some for buybacks, some for dividends for the capex, but not that much over the years. And again, as everybody else, everybody is going to grow free cash flow per share, allocation, capex, growing, prioritizing buybacks. That I don't agree, especially not in good times. Maybe you can say, okay, we'll save money to buy in bad times, but not when the situation is good. They have the new projects at a 35 break-even, and you can see here growth projected going forward, their targets, everything looks great on their presentation. And you can see here energy demand growing depending on the scenario, the oil situation, stable or even growing. And that is the key question. How will all these oil majors grow, produce, and even make more money on that production? I don't know. I think they will all grow, but not in 10 out of the 10 years, as it is a cyclical. Maybe in 3 out of the 10 years, they will reach their targets. Now, if I said that Shell, Exxon, Chevron are expensive, TotalEnergies has a dividend yield of 5.8% and a buyback yield of 5.7% for an 11.5 shareholder yield. So this must then be cheap. And let's look a little bit at the company. They're doing all kinds of things, even electrical energy. They're investing heavily into all the energy scenarios there, but they also see oil demand growing over a while, therefore they can invest there, and then only declining later. And you can see here, the oil and gas industry needs to run fast just to stand still. That is the projection, but we'll see how real will that be over time. Global demand growth expected to go. Global stock change is growing. There is short-term abundant supply, soft demand, opportunistic price response. So US shale oil production sensitive to oil price, so that's something to keep in mind. However, gas markets also, they are going to grow there, and they expect demand to continue to grow there. So they are a little bit more diversified on things than others, and they also deliver superior free cash flows. And you can see here, high free cash flows, 20 billion likely to be delivered in 2030. Now we are at 8-9 billion, then growing. Even then, the power, the electricity they are investing in should be delivering returns. They should keep the dividend at oil above 50, at oil at 70, they should reach much higher cash flows, share buybacks, and things like that. So for now, we are looking at the cheapest situation there, but then again, post-dividend break-even, if oil is at 50, then you'll just have a dividend. British Petrol, also you can see the returns over the long term. So there are these exuberant times, and then there are these bad times, and those even out. And then all these presentation capital market days are worth less than the digital presentation value of those. You can see here global energy consumption to grow, They even expect oil to grow, but this also explains the sensitivity. So they expect growth over 10 years, but if it's just here, then this is the oversupply, and that has a big impact on oil prices. Again, something that these majors do, they buy something and then they sell something, or things like that, reshaping the portfolio constantly. Adjusted free cash flows, now look at this, 2024 at 78 billion, 2027 at 75, will be 15 billion. How are they going to grow? Like everybody else, everything is going to grow. Everybody will have high returns on average capital employed, 16%. I think Elon Musk would be happy with such a return. So perhaps he'll buy oil majors, reallocating capex, transition businesses more into oil and gas. You see here more growth, growing the upstream. But when you look at things, when you look at that return on invested capital, yes, it is great when oil prices go high, 23%, 13%, but it is minimal when oil prices go lower and don't meet the expectations. So on average, 8, 9%, and then you have to play around those cycles, sell when they are targeting great returns and buy where they are targeting lower returns. Of course, the market cap $93 billion. If they reach the 15 billion, that's a 15-16% free cash flow yield there going forward. But oil has to be at 74 or 80 nominal to do that. Good dividend yield, they project growth doubling, so must be a great investment. Then we have Equinor, we already discussed it a little bit, high dividend yield, 7.8%, and they are also investing oil and gas production growth, 4%, again, more growth, return on average capital employed, more than 15%, high cash flows, increasing production growth. I don't see that decline that they are saying when everybody of the majors is investing for more. And cash flow neutral at 35, first at 40 and then at 35. So this tells me something else. So that majors are break even, some at 50, some at 45. If oil prices average, we can see 45. That's something very interesting depending on oil prices. Of course, low production cost in Norway. So when you look at all these players, this is my conclusion. How can everyone have high returns on invested capital in a highly competitive environment? If I can invest $1 million in a well and get 15% out of it, somebody will invest next to it to get 13, 12, 10, 8, especially when interest rates are at 3%, 4%. That doesn't really fit. Everybody's break even at 40 and they expect oil prices at 80. If your break even at 40, oil prices will be at 45, 50. Why would Saudi Arabia or the other players give you to make more money? All expect growing demand, and the current free cash flow yield of 10% and expected growth going forward screams risk. And you can see here very high yields, let's say 8% buyback shareholder dividend yield if you invest in oil players now, which is very, very high. But let's discuss the key projections. Oil majors see oil at 70 or even 80 going forward. But the agencies say we are in an oil glut and oil prices to go lower. Oil demand is forecast to plateau this decade, so for now they don't see growth, they don't see decline, but okay. And you can see here lower and lower growth in oil demand, but everybody is investing in additional supply there, so that might create oversupply and lower prices. And you can see here the supply increases, but why it's declining here? No, they just invest to imply here. You're not going to invest now to add production in 2030. That's the lag with oil. It's not a copper mine that you need to invest 15 years ahead. EVs are a reality. teleworking, especially with AI, people will not be working, so oil demand might be displaced by non-working. And that's the reality. Electric car sales in China are growing. Even now, they are developing technologies for trucks. So technologies are there, efficiencies. The good thing for oil is that there is still a lot of growth, economic growth globally. But the truth is that oil prices are low compared to higher earlier prices, compared to what the majors would expect, and unfortunately expected to trend even lower. Oil prices to drop to 53 in 2026, and oversupply is what Goldman sees, all the others. So the last big oil supply wave the market has to go through, and then in 2028, Goldman expects prices to go higher. So that might give us the opportunity to buy more oil stocks in the low if this is right. And that is something you can even adjust earlier because nobody is going to look forward that far. So this is Goldman 8076 late 28, but they also say that now on the oversupply can fall to the 40s, which means no cash flows from more, dividend cuts, much lower stock prices, 50% down for Exxon and things like that, and that is a risk. JP Morgan says that it can go even lower. It can go even below 40 towards the 30s. Demand, defying widespread bearish sentiment, has consistently exceeded expectations. Yet, supply has outpaced these gains by more than twofold. That's why they are looking at the low 30s per barrel, especially if there is a situation like a recession on things like that. And they expect already slip below, going towards 50s in the final quarter of 2026, and then going to the 30s by year 2027 and on all that growth that we have already discussed. And keep in mind the break-evens, 30, 40 on new projects, on the older are even lower. Some people dig oil up between 7 and 10, 12 for what's already there. So they'll keep pushing oil out to make more money, to survive. And you can see here the break-evens 50, 35. So perhaps we're going to see oil at below 50, perhaps above 80. Perhaps we'll see both in the next 5 years. And keep in mind, as always, cyclicality. Now we are somewhere at the mid-level, at 40s. That would again be a low-risk, high-reward oil investing scenario. For now, we are expecting a super glut. I've looked a little bit at also at what Trafigura is saying about their trading oil and looked a little bit at their annual report. So huge supply. China is buying a lot for its strategic buying. You can pause this, read a little bit just from the key players there. Here are the Chinese strategic buys that keeps prices higher. But if that stops, when they fill their inventories, that is it. So oil 50, maybe 40, maybe 65, but projections are made on 75. Those are exuberant projections. If you just look at Exxon's, things like that, it's too expensive now and extremely risky, especially with all the cash flows, the returns they are saying. If the real Brent is at 55, you can expect 50% down on those cash flows. Similarly, the stock price to follow. I always think you need an oil strategy to have. So let's say oil is now at 60, it can go to 40, it can go to 80. So simply do that. Let's say 2% of portfolio now. Then if it goes to 40, you increase to 8, 10% of the portfolio. When it goes back to 80, because of its cyclicality, you sell everything. Tack, you made your 2x, 3x from oil, and then you say thank you. Not from the dividends, even if it sounds counterintuitive. With these cyclicals, when the dividends are good, when the cash flows are good, that's not the time to buy. That's the time to think about zero exposure, especially if you have Exxon or Chevron in your portfolio. Of course, on the other hand, there can be political shocks, wars, things like that, deviation of ships through the Suez Canal. Who knows? That can always temporarily push oil prices higher, but that again leads to the exposure. If you have 2% like I do now, if it goes higher on some kind of situation, then you trim back to 2% or sell when you make your money. If not, if it goes lower, you reinvest the dividend and build those positions through 2026 and 2027. I hope you enjoyed this bottom-up perspective on the sector. That's what I do, research. Check my research platform for a value investment pillar to your long-term portfolio.